Hello, it's Gus Tucker at Financial Freedom Fridays. How are you doing? It's good to see you. I'm excited about today. We're going to be going through something called an Index Universal Life, an IUL. Um, and it's what we sometimes it's called a switchblade, not switchblade, Swiss Army knife of financial services because it can cover a lot of ground for you. So I want you to listen closely. As a matter of fact, let me I got to do something real quick over here on this computer, see if it'll let me do it. Do that, do that, do that. Here we go. Now we're going to supersize this again. All right. So what I want to do is talk to you about an Index Universal Life. And the reason I want to do it is one of the things we say to people is don't put your money in the bank. Put your money where the bank puts their money. Okay? Banks have classes of assets. And you can look this up, tier one asset. Go to a bank, tier one asset, and look up BOLI. Just Google BOLI. It's called bank-owned life insurance. And your bank, if it's one of the big major banks, owns hundreds of millions of dollars of life insurance. What? My bank owns life insurance? Why? Because life insurance companies are some of the most well-financed companies on the planet. During a recession or a depression, more banks go out of business than life insurance companies. Why is that? Because life insurance companies have money. When you get a life insurance policy, they're making a promise to pay if you pass away. If you pass away, you can't say, oops, I was just kidding about paying you that death benefit. That was a joke. I'm really not going to do that. No, you can't do that. You can't do that. So banks have set aside reserves. And then, insurance companies have set aside reserves. And then they have reinsurance companies that reinsure their risk. Whoa. That's why if you in your town, two companies have the biggest buildings in your town. They're the banks and the life insurance company. Why? Because that's where the money is. So don't put your money in the bank. Put your money where the bank puts their money. And a fair amount of their assets are in what are called tier one assets called life insurance policies. Okay. Now, everybody's got these three basic options for their money. You can put it in a fixed account. How many of you have a high yield savings account from like a bank that doesn't have a lot of brick and mortar and you can get higher returns? Like in today's market, 4 or 5%, 5.5% on your savings account. But usually it's from a non-brick and mortar bank. That's fixed. So boom, it's just going to be fixed throughout the year. Then it's variable. That's the stock market. It goes up and down based on the performance of the companies in the market, and sometimes based on outside things that don't have anything to do with the performance of your company. It could be political things. It could be a natural disaster. It could be other things that cause the market to be up and down. And when that's the case, your investment is up and down. And then there are indexed accounts. These indexed accounts are usually owned by insurance companies, usually, not always, not like stock indexes, but it's an indexed account run by an insurance company. And they will use indexes like the S&P 500, Russell 2000, all kinds of different indexes. And your money isn't in the index, but it's like a mirror. Like when you look at a mirror, what you see in the mirror is not your face. Well, it is your face. But if you punch the mirror, you don't feel it. It's a reflection of your face. So when you have an index inside a life insurance policy, it's a reflection of what's in the market. Your money isn't actually in the market. So some cool things happen because of that. You see those locks on that screen? At each high point, your money locks in, because then you see how the market goes down, like that first lock. You see the market goes down. But that green line didn't go down. Why? Because you're locked in at that point. You're locked in at that high point until the market comes back and it gets past that high point to the next lock in. situation, which is at a higher level. During those negative periods, you know what you get in your account? Somewhere between 0 and 1%, depending on the company. Yeah. You don't participate in losses based on the market. Based on the market. Okay? Now, your index can underperform and there are costs inside your insurance policy. And your account could go down because your costs were higher than your returns. Can that happen? Yeah. Does it happen a lot? No. But you have indexes. That means you have a floor. It could go up, down again. It'll back. Okay. That's important. We're going to show you why that is in a minute. Because Warren Buffett says in investing, rule number 1 is what? Never lose money. What's rule number 2? Don't forget rule number 1. Okay. Warren Buffett is not about losing money. He's a guy that's got almost $200 billion in cash on his balance sheet right now. Okay. And this is the mathematical impact of losses. 2007 and 2009, some of you guys were invested at that point. The market was down almost 55% during that time period. Okay. But for you to get back to zero, you had to go up 123%. 123% to get that 55% back. Almost 2+ times what you lost. And the other thing you lost was time. Because if you wanted to retire between 2007 and 2009, could you? No. Because your account was, man, half the size it was before. You had to wait for it to come back. Because if the account would have been down, plus you'd have been drawing out money for retirement, man, you'd have been hosed. Okay, so losing money is expensive in 2 ways. 1, you lose the money, and 2, you lose the time. Okay, and as you get older, man, time is important. Time is very important. Next thing is taxes. So first is you want your money to grow. The second thing you want to grow is grow without being taxed. Hey, they have tax now accounts. If you have a savings account, a CD, bank CD, money in stocks, bonds, mutual funds, regular retail investments, and your investment grows, you're going to get a 1099 about the interest or the dividends that you got from that account. You're going to get taxed at it. You're going to get taxed on that money at your ordinary income tax rate. What? Yep. That's tax now. Tax later is any account that's got a 4 in front of it, 457, 403, 401, K, right? Those are tax laws. Those aren't investments. Those are the tax laws. They give you a tax break today, but at some point in the future, you got to take your money out. And guess what's going to happen? You're going to get taxed at your ordinary income rate while you're retired. When that's the last time you want to be paying money for taxes. When you're retired, hello, you want that money in your account, yes? So you have tax later. Then you have tax never. Well, you pay tax on it up front, potentially. There's a couple strategies where that maybe we can deal with that too. That's another conversation for another time. But this is a tax strategy where you've paid your tax today on what's called your seed. Now think about this. You buy a bunch of seed and then you go out and plant it in acres and acres and acres of land. What would you rather do? Pay tax on the cost of the seed or pay tax on the value of the harvest? Obviously, the cost of the seed is a lot less. Exactly. The government in the tax later programs, they give you the seed and they tax you on your harvest. Ooh. Why? Because it's more beneficial for the government. Tax never is pay your tax up front, but then grow your harvest and don't pay taxes on it. And that's like Roth IRA, and the cash accumulation inside this life insurance policy allows you to do the same thing. But it even gets better. Because these are 4 things that happen inside this life insurance policy. First is protection. And we're going to talk about that, right? There are threats against your financial future that you have to protect yourself against. And we're going to go through what those threats are. But I joke with people, but it's not funny. There are two things that can screw up your financial plan really, really bad. Guess what they are? One is dying. That'll mess up your plan. As we say, that'll put a hitch in your giddy up. Number two is almost dying. And almost dying can be worse because you can't work, but you're creating more bills. Woo. A life insurance policy can help you. If you die, it'll pay money out to your family for your loss of income and income earning potential. But if you almost die and you have a critical or chronic illness that keeps you away from work, you can have an umbrella type policy with your life insurance policy that pays you while you're alive. Whoa. They're called living benefits. Next are tax advantages. Our goal for our clients is to help them retire in a zero tax bracket. There's a book out there, and I'll show you a picture of it in a minute. It's called The Power of Zero. It's the power of retiring in a zero tax bracket, where you're not paying tax on any of your income while you're retired. So imagine you want to get $60,000, $70,000 a year during your retirement. Your retirement can last 20 years. 20 years times $60,000 is $1.2 million. If you're even in a 10% tax bracket, you've just given the government 120 grand. How does that feel? Here's a check, government, for 120 grand while I'm retired. You don't want to do that. So you want to have tax advantages where you're not paying taxes during your retirement. The third thing you want is safety. Like a friend of mine was just talking to her, she's about to buy a house. Now, she hasn't thought about this, but you know what the most important part of that house is? And you don't go in, you don't go look at it, you don't really ask about it. But if something happens to it, you're going to be mad. It's called the foundation. The foundation of your house. What if it got holes in it? What if it's cracking? Man, those kitchens and bathrooms and bedrooms don't look so good now because the foundation, this thing about to fall down or have water in it or whatever. That's called safety. You got to have a firm foundation for your money so you're not scared you're going to lose it. Okay? Safety. The fourth thing is you want to grow because in your future, you're going to take a hit during retirement. I call it a hit. H-I-T, hit. What's the H for? Healthcare costs. Are healthcare costs going up or down? You should have seen the bills from my brother's kidney transplant. Thank God he was in the VA. And a ride in an ambulance from our house to the hospital, which wasn't that far away, was several thousands of dollars. Man, hit. H, healthcare costs. I, inflation. Have you noticed the cost of anything's going up recently? Inflation. Inflation. There was some gas in downtown Chicago the other day, $6 for premium gas. $6. 1 gallon. $6. Inflation, and T is taxes. So when you retire, you want to avoid the hit. You want your money to grow, but you don't want it to take a hit while it's growing. Does that make a sense? But your money needs to grow more than that hit, or you're actually going backwards. All right? All right. Now, one of the things that's true with index universal life policies is you're looking at the return of your money. Okay? ROR is rate of return. In a traditional policy, okay, whatever the market does or whatever the investment index does, that's what you get. If it goes up 3%, you get 3%. If it goes up 5%, you get 5%. But what if the company you were working with gave you what's called a participation rate or a multiplier? So if the market did 3% and you had a 200% participation rate or multiplier, you actually got credited 6% in your account. Ooh. I've seen and am aware of index universal life policies with 200 and 300% participation rates. How do insurance companies do that? It's another discussion for another day, but they do, and they can do it profitably. So if you get 3% performance in the market, you'd actually get 6% credited to your account. Now look, the S&P 500 over time has done about 8%. Not every year, but over time. Some years up, some years down. But remember, in the IUL, when the market is negative, you get 0 to a positive number, typically 0 to 1%, depending on the company inside your account. But what if it did 5% in the market and then you got a 200% multiplier? You get 10%. Or if it does the average of 8% times 2 is 16%. What would you rather have? The traditional, where you get 100% of what the market does, or the more modern, where you get a participation rate, a multiplier? Or do you have multipliers on your accounts? Just asking. Here's a way to make that happen. Pretty cool, huh? Yeah. So this is the book I was talking about right here, The Power of Zero by David McKnight. These are 18 books that the professionals that are a part of our organization are required to read and have a handle on. Okay. Here's one of them that I would suggest you get. It's called The Power of Zero by David McKnight. The Power of Zero by David McKnight. All right. And here's another book I suggest you get. It's called The 8 Financial Breakthroughs. Now, I wasn't supposed to tell y'all about this, okay? Because it's available on Amazon, but we're going through some final edits. Okay, so you can still buy the book, but we're doing some final edits, okay? But it is available on Amazon. It's put out by our company. It's our CEO, Alvin Darien II, and the Financial Pro Network Innovation Team, of which I'm a part of. We were contributing authors to this book. And one of the 8 financial breakthroughs, and one of the things you have to protect yourself against, if you're going to break through financially, a hammer is breaking through. If you're going to break through financially, one of the things you got to handle are threats that are going to destroy your legacy. Threats. Yeah, there's 10 threats that can destroy your legacy. We're not going to spend a whole lot of time on them today. We spend time on them in the book. But one is disability. We were talking about not dying, but almost dying. Inflation, running out of money, losing money in the marketplace, taxes, identity theft, having a chronic or critical illness. I have a niece in her mid-30s who we thought we were going to lose her a couple weeks ago because she had some blood clots as a result of a pregnancy that didn't surface, but they did surface, and she had some major health implications, and we thought we were going to lose her. Mid-30s, with 3 children. Ooh. Critical and chronic illness, because they can happen. Okay? You get the wrong information. You get money off social media from somebody who's really not an expert, and then you act on that, and then you get hosed. Or you procrastinate. You just wait and you don't do what you're supposed to do when you're supposed to do it. It costs you dearly. So these are threats that'll destroy your legacy. We want you to take action, to have a plan to handle those. And what we do with these 8 financial breakthroughs is help you handle things like these threats as we put together that plan with you. Does that make sense? Next thing, let's talk about this Index Universal Life. Okay. The Index Universal Life, inside of it, there's 2 major parts. Okay. You put money into it. It's called a premium. and you're paying a premium for it, you are, because it's an investment in your future. I'm not saying the insurance is an investment vehicle, but I want you to think of it this way. It's not an expense like buying potato chips or groceries. This is going to have a long-term benefit for you. It's going to become an asset for you. So there's two major parts to this policy. There's the savings and investment part, and then there's the cost part. And typically, the younger you get this, the lion's share of the money's going into the investment part and not the insurance part, because you're young and your possibility of dying is a lot smaller. So what's inside the IUL? Now look, majority of people put their money in the bank, and now you're not getting 1%. You might be getting 3, 4, 5%. Okay, why do you want that if it's liquid? Wealthy investing their money, compounding at higher rates than your bank investment are. And the ultra wealthy are really smart because they're not putting their money in the bank. They're putting the money where the bank puts their money and looking at investment grade life insurance that has some tax advantages. So what typically happens is index, it's using different kind of stock indexes, bond indexes, both US and international. Sometimes they're capped, sometimes they're uncapped. They can be a capped as lower percent, 10%, but then they have them uncapped, but they have a floor so you can't lose money. So if the market goes negative, you can't lose money. Zero is your hero, but it can be uncapped. And if you have the participation rates, you can get 2, 3 times the market's performance. You get to control the money that you put into it. There is a minimum you need to put in to make sure you cover the cost of the insurance, but there's also a maximum that's a lot higher than a Roth IRA. Do you know you can make too much money and you can't contribute to a Roth IRA and get the tax advantages? But inside this life insurance policy, we can set it up so virtually you don't have any cap in terms of how much money you can put in it. Okay? And there's no 59 and a half. You know, if you take money out of a retirement account before 59 and a half, you got to pay the regular taxes on it. Plus, you got to pay a 10% tax penalty. There's none of that inside the Index Universal Life. Also, unless the tax laws change, money that you put inside the Index Universal Life doesn't count against your child's FAFSA, your family contribution towards your kid's college education. Then it also has what are called living benefits. That's what I was talking about. If you have a critical or chronic illness, built into the policy is an acceleration of the death benefit if you have a critical chronic illness. For instance, I have a very good friend who had a nephew, because he ended up passing away, but he contracted cancer. And he had 7 children. His wife still has 7 children. So 7 children, and she didn't work outside the home. And guess how much life insurance he had on himself when he was the only breadwinner? Exactly 0. With 7 children, and he was the only one working. And he had 0 life insurance. That's not uncommon, guys. How many of you out there are single parents with no life insurance? How many of you guys are out there married with no life insurance, or the only insurance you have is with your job? You leave that job, your family's out. Okay? So this person was a professional, and they were a professional in a particular sport, and they couldn't practice. They couldn't play that sport anymore. And the wife didn't work outside the home. So it took about a year and a half for my friend to get his nephew to get this policy, a $500,000, what's called a term policy. So it wasn't building up cash like this is, but it had living benefits on it. Make a long story short, complained of stomach pains one day, went to the doctor, stage 4 stomach cancer. He had this insurance policy about a year and a half, paying less than $100 a month. He was able to withdraw out of the policy $440,000 to help take care of his family, provide some alternative health treatments for him, and pay his bills because he couldn't work anymore. And they got 7 kids, they're homeschooling. She couldn't work either outside the home. Where would they have been had they had not that insurance policy that they were paying a whopping $60, $70 a month for, that wrote them a check of $440,000? That's the living benefits part of it. Okay? So those are the key parts of this. You got the insurance, you got the growth of cash inside the policy that typically by age 65, if you started in your 20s and 30s, there'll be as much cash in the policy as there's death benefit. So as a rule of thumb, let's say you bought a $500,000 policies in your 20s and 30s. By the time you're in your 60s, you'll have $500,000 of cash inside the policy that you can take out tax free because you're taking out in terms of a loan and the loan isn't taxed. How cool is that? And you can take money out along the way as long as you have the money in it and it's performing, you take money out as well. Okay? That's an IUL, the basics. 8 benefits, tax-free supplemental retirement income. That money you're taking out, I was talking to a young lady yesterday. She's 31 years old, and we were talking to her, and she's doing real well financially. And so she's going to be able to fund this policy at its maximum. At 65, she's going to be able to take out $12,000, $13,000 a month in income, tax-free. And in 3 years of retirement, she would have taken out all the money she ever put into it in the first 3 years of retirement. Is that a good deal or a great deal? Put it in, start retirement, taking out 13 grand a month. In 3 years, you're taking out all the money that you ever put in, and you're not paying tax on the money you're taking out. Taking out 13 grand a month and zero tax. Let that sink in. Tax deferred growth. While the money's growing, it's not being taxed. Now, this person's going to be putting in a couple thousand a month. That's 24 grand. You can't put that into an IRA. No 59.5% rule. They can take it out before 59.5 if they want to. No taxes. Growth potential, participation rates. This particular policy I'm recommending to this person has participation rates of 235%, 215% on the performance of the index. So it's got great growth potential. It's got safety from negative returns. Zero is your hero. Flexibility and control. I can't put 2 grand this month. Well, the minimum amount you could put in is like $200. As high as 2,200. So it gives you flexibility. And the death benefit will go to her beneficiaries tax-free. Now, how cool is that? As a part of your strategy in building wealth. So if you look at these 5 different financial concepts, bank, 401k, Roth IRA, fixed indexed annuity, and IUL, tax-exempt distribution, the Roth IRA and the IUL, the other ones, when you take the money out, you're going to pay taxes. Growth potential in the bank, not really, because it's fixed. No risk of loss. The bank, yes, but not an IRA or 401k. But yeah, these insurance products, the annuity and the index universal life, yes. What's the only one that has all of these? Oh, let me go back. What's the only one that has all of these? Tax exempt distribution, growth potential, no risk of loss. You can access it. Okay? You can protect yourself and your family, protect your income. Critical illness or long-term care. You get an illness or you live too long, so to speak, and you need long-term care inside your house or in a facility. You can draw the money out and use it for that. Legacy, a death benefit, and avoid probate. Probate is essentially a lawsuit against yourself because the state is going to determine who gets your assets. And the reason they're in a legal process that you're paying for that you could have got taken care of with a couple simple documents. Okay? So get all the advantages: tax-deferred earnings, tax-advantaged loans, tax-advantaged cash withdrawals, tax-free transfers, tax-free death benefits. From tax-free income to long-term care protection, chronic and critical illness, IULs are a multifaceted, remember that Swiss Army knife tool that can address many financial needs. So depending on what your goals are, depends on how you can structure it and set it up, depending on what your goals are. Would you like to know your numbers? Based on your plan that you have for your future, what should you have as a death benefit, as a living bit number, as a supplement to your retirement, tax-free? Everybody's situation is unique. Get with a professional today. I encourage you, we use this information, your age, your income, whether you smoke or not, and how much money you can commit, as some of the inputs to figure out what it is you're going to need. But finally, look, what's your cash flow pattern? What's happening with your money? Is your money going to savings and investments, or is it going to perishable items? Are you building assets? Or are you building liabilities? Are you willing to make changes to change your patterns? Are you building assets? And are you willing to start? What I encourage you to do, you can hit me at this QR code, and it'll take you to my calendar, or hit me up at one of these, and let's put together a time where we can do what's called a financial discovery and figure out where your money is going and where it needs to go to create for you the lifestyle that you want. Okay, it's Financial Freedom Fridays. Gus Tucker, great chatting with you. Like, subscribe, share this with other people. Get serious about your financial freedom and having your money be directed towards creating for you the lifestyle that you want. You guys have a great weekend. All right, take care. Bye-bye.